I'd like to invite the members of our third panel to join us now. Welcome, Greg and Yanni.
Hi, Greg.
Let's start things off with some quick introductions, as we did with the previous panel, name and title, and a little bit about your role in the industry. And I'll start with Greg.
Hi, thanks, Loretta. Great to be on today with everyone. I want to thank IREI for putting this on. My name is Greg Jenkins. I'm with Invesco. We have a large global real estate platform. We're also very active in the defined contribution market. As a firm, we have about 150 billion in DC assets in the US. And we're also very active in the DC Real Estate Council. I know a couple of other panelists have brought that up, and it's a really important organization for those of us interested in the DC market and this business, especially at establishing things like best practices. So it's been a great group, and I would encourage anyone who hasn't gotten involved in that to do so.
And Yanni.
Thank you, Loretta. I'm Yanni Venture. I'm an executive director at JP Morgan Asset Management. I'm essentially responsible for the growth and strategic management of all of our DC real estate solutions. And if you think back, JP Morgan now has a 16-year track record of managing private real estate for DC investors in their solutions. So we've been in the market. I think we've seen the evolution that's taken place to where we are today. And I think the argument for including core private real estate and REITs in DC plans is stronger than it's ever been.
So I want to start by just asking you both, as I did with the previous panel, you've been following along. Do you have any reactions or comments regarding what you've seen so far? And I'm going to start with Yanni.
I think they very well articulated the benefits and how complementary private real estate and REITs are for DC investors. Also the portability potential in MEPs and PEPs for retirement plans. And at the end of the day, I think Tripp had a really good point where he was like, the time is now. You can look at the benefits that private real estate and REITs offered over the last cycle, but we are in a new cycle today. And from a macro perspective, the blend of core private and REITs can even offer greater benefits going forward if you think about what they mentioned in terms of inflation and absolute returns. Greg, I'll hand it over to you.
Yeah, I was gonna say, Greg, any comments?
Yeah, I think it's been a great discussion. It's been good to have the time to get into depth on a lot of these issues. And I think we've covered a lot of them. Pricing, we've talked about roadblocks for plan sponsors and for the marketplace in general. And yeah, we're looking forward to talking about some of the implementation and how do you really put private real estate to work in DC plans.
Well, let's start off with the question of where does real estate fit in a modern defined contribution plan? And Greg, did you want to take that on?
Yeah, do you want to bring up our slides? While John's doing that, yeah. So I've been in the defined contribution marketplace for about 25 years, and when you look at DC plans in a big picture, where really what real estate can do is add diversification, and this is definitely something that's needed. When you look at where DC plans are allocated today, they're dominated by very traditional asset classes, equities and fixed income. I was just watching a pretty prominent market strategist this morning on TV who said that the golden age of the 60-40 stock and bond portfolio is over, and I think he's absolutely right. I think that we're getting into a period where that traditional portfolio just isn't going to pay off the way it has in the past, and I think that real estate can fit that. Now, most in the industry believe that real estate belongs in managed portfolios, whether that be target date funds or real assets portfolios. And so that's really the way I'm going to be talking about it today. I think standalone real estate, as it's been pointed out in some of the previous panels, standalone real estate doesn't really have much of a place to me in DC. Maybe that may be a little controversial for some people. I know it's been done, but I think for everyone everyone's interests, the plan sponsor, investment managers, and the participant, most importantly, that it belongs inside of managed portfolios. So let's flip to the target date slide, if you could, John. And I think the most obvious place for real estate is in target date portfolios. So target date funds make up about 30% of assets in DC plans as a whole. And that number may surprise some of you. Some of you may think it was higher, but I think the reason it feels like it's higher is because many plans report that 80% of new assets are going into target date funds. So there's no question that wallet share for target date funds is going to grow. And one of the best things about target date funds when it comes to things like real estate is that the flows are predictable. So I mentioned 80% of inflows are going into target date funds, and target date funds really have not seen outflows like other parts of the DC menu, even during the global financial crisis, even during the depths of the pandemic. We just didn't see outflows in target date funds. And that's very helpful when you're trying to invest in illiquid asset classes like real estate. So this is what you call a glide path chart. And this is very simple, back of the napkin. Typically there's a lot more asset classes involved, but wanted to give you an idea of where we typically see real estate fit into a glide path. And here, let's assume I'm talking about Odyssey funds. I'm talking about, down the fairway core real estate. And so in that context, we have, I'm showing here on this chart where real estate starts at about a 3 or 5% allocation in those middle years, and then grows to about a 12% allocation for a participant as they go into retirement. And so this is the standard way that real estate's been used. Not everyone agrees, but I think this is what we see typically. Now, if you were to introduce other types of real estate, say, higher risk real estate, value add, maybe with higher leverage, that's where you might want to change the allocation a little bit. Or if you introduce private real estate debt, you might want to increase that for an older participant. But the idea is that you're trying to replace equities and take some of that volatility off the table. And that's typically what a manager is trying to do with private real estate in a target date portfolio.
Right. So go ahead, Yanni.
So Greg, if you think about how the relative positioning of core private real estate has changed to traditional asset classes, and the views that our capital markets team has, where they're actually being controversial in saying that core private real estate is expected to outperform equities on an annualized basis in the next cycle, could it even support the argument for a higher allocation earlier in the glide path, where we've seen clients that have a static allocation across the board and then increasing that to 20% closer to retirement? And that's been more of a recent phenomenon post-COVID. Yeah,
I think that's a great point, Yanni. And I think that's certainly possible. And if things play out the way that many people expect them to, then we could see things like private real estate take on a much more prominent role even earlier in a glide path. It's a very good point. I wanted to mention something about vehicles. I think that this was mentioned earlier. So target date funds, much of the assets in target date funds are still in mutual funds. And mutual funds are going to have a very difficult time including private real estate. I'm not going to say it's impossible. It is possible, but it's very difficult to do. And you're probably going to have to water it down to a state that we don't necessarily want. The vehicle where it's going to work much better is in a collective trust or a CIT, as it's referred to often, or in an insurance separate account, an insurance vehicle where you can include asset classes like private real estate. But there's and that's something that I think we all need to come to grips with here. Is the history of defined contribution is mutual funds, and that's why we haven't seen the same adoption of alternatives like we've had in defined benefit plans. That's why it's evolved much differently. It is all revolved around mutual funds. The good news is that as Tripp pointed out earlier, target date assets are trending towards collective trusts, and there's a lot of advantages for that. But that's good news for real estate, because it makes it much easier to implement. Now, we've seen mostly custom target date fund adoption, but there's also growing interest on the off-the-shelf side as well. And we're seeing more and more inquiries and more interest in private real estate in that context too.
And Greg, I think if I'm listening to the implementation side of that, from a plan sponsor's perspective, it's important for them to understand what is their liquidity needs when they're looking to invest in real estate. One topic that doesn't get addressed a lot, but that's also very important that we've run into, is looking down the pipeline. Are there any corporate events that would change their view of investing in a less liquid asset class today? Because essentially investing in real estate is managing liquidity at the plan level and managing your liquidity needs within your real estate allocation. And what we've seen is investors rebalancing to their traditional asset classes on a daily basis, and then on a monthly basis, rebalancing back into their real estate. And that's a consideration and a conversation that they have to have in advance. And especially when they're looking at their real estate allocation, whether that is 7% or 15%, that blend of public and private that's been mentioned in a couple of the prior panels, what's appropriate for them today? Is it a 15% allocation to REITs or a 25% allocation to REITs, based on their participant liquidity needs, glide path volatility, and rebalancing? So there's a number of considerations that investors can think through to evaluate what's the size of their allocation, where are they today, and how much liquidity do they need in that real estate allocation?
Thank you. And Greg?
Yeah, I think Yanni made a number of good points. And in terms of looking at cash flows, that's something that's really important when adopting private real estate, is for, look, everything needs to be out in the open with respect to liquidity needs, history of cash flows, and all parties need to be aware of any potential pitfalls. And what's interesting is nothing's new about this. This might sound a little bit odd or a step too far, but we've been doing this with stable value for years and years. We're a large stable value manager, and when we underwrite separate accounts, we have to look very carefully at the history of cash flows and corporate events, as Yanni mentioned. And there's some industries that have big, labor inflows and outflows, for instance, and it makes some of these things difficult as well. And I think you have to look at how. So, say you're looking at a target date fund. How is that target date fund rebalanced, and how is that rebalancing going to work when there's extreme market activity, when equities, go up 25% or go down 25%? What is that going to do? And I think, thinking ahead and looking at stress testing of all these things is really important to the success of, including any kind of a liquid asset class in DC plans. Did you want to turn to the next slide if you can? We can talk about another implementation, and that is real assets funds. So another kind of obvious way to use private real estate is in a diversified real assets fund. And so here I've got another back of the napkin example, just to give you a sense of what one of those funds might look like. And in this case, we've got 4 parts equally allocated to private real estate, listed infrastructure, commodities, and tips. Now, the interesting thing about real assets is not everybody agrees on what belongs in this kind of portfolio and what doesn't. So it's interesting talking to clients because not everyone agrees, and there's a lot of thought about what's included there. There are a few considerations that are different about a real assets application versus a target date fund. So keep in mind, this is going to be sitting on the menu as an asset class or as an option for participants. And so there are some things that come into play that don't with a target date fund. So I mentioned that with target date funds, the asset flows are very predictable. We know the money's going to keep coming in. We know there probably won't be much in the way of outflows, and that's going to continue. Well, with an option on the menu, like a real assets fund, that's not going to be the case. There could be unpredictable inflows and outflows. So that's something that you're going to want to take a look at. There's also a greater educational burden here. If you include private real estate in a target date fund, it's probably a footnote or a mention somewhere in the materials. If you've got a real assets fund with private real estate, say at 25%, you really need to do more education so participants understand exactly what they're buying, because there's a lot of confusion. We've done a lot of focus group work at my firm, and there's a lot of confusion about what some of these asset classes are. Real assets is a very confusing term to a lot of people, and many people have different views about what it is, and not all of them are correct. So there's definitely more of an educational burden. I would also look at, and I know Yanni's got a lot of opinions on this as well, but you also want to make sure that you're not, making this kind of a portfolio 50% private real estate. That's too high. You need to keep that number more reasonable so that the liquidity works for everyone.
Yanni?
No, I definitely agree with that, Greg. And it's great to see that you're really talking about the considerations for a real asset fund or a white label fund, which is essentially a fund solving for something, for income, for growth. We've seen an increase in clients and investors requesting real asset and white label funds on their core menus, including private real estate. And historically, what managers have done to reduce the cash flow volatility of the other asset classes on your real estate is essentially capping that real estate allocation at 20% or 30%, depending on the volatility of the other asset classes in this bundle of solutions. And it's becoming more and more frequent, and they want to make the asset class more broadly accessible. And there's clients that already have it in their target date fund suite, and now they're including it on the core menu. So I think there's definitely more to come of real assets on the core menu.
And I just had a quick question. When I was looking at this, I noticed you put in listed infrastructure. Is that because there just isn't in a sort of a private infrastructure approach, or is there a preference for listed over private?
Well, I think in a DC structure, listed is really the only way to go at this point. And that, that could certainly change. But when you look at private infrastructure funds, typically you're looking at long lockups and a lot of other barriers to making that work, in a daily valued context. Listed infrastructure is actually a really interesting asset class. If you haven't looked at it, I would ask anybody to do that. It's quite a bit different than REITs, and there's a lot of interesting advantages to listed infrastructure that we won't get into now. But it's an interesting asset class.
Any other comments on this slide?
I really think we've covered them well.
Shall we go on to the next?
Yes,
Yep.
Why don't we move to the case study?
Excellent. And I just want to mention before Yanni gets started that I am monitoring the questions through the Q&A that come in, and I'll be posing them to Greg and Yanni after we finish the case study presentation. So please continue to ask your questions, and I will do my best to get to them.
Thank you, Loretta. So in the case study, we're looking at age-old question, liquidity, how much is enough? And view this from the perspective of a plan sponsor that's evaluating what is the balance of public and private that they want in their real estate allocation to satisfy the benefits that they're looking for from the private side, but to also provide sufficient liquidity to rebalance and satisfy participant flows. So imagine that we're looking today at investing in a vehicle that's, for example, 15% REITs or 25% REITs and 75 to 85% private real estate. But first, we're going to look at market behavior. Then we're going to look at investor behavior to try and address the question of how much liquidity is enough. So we're looking back approximately just less than 2 years, and we indexed 3 different asset class behaviors at the beginning of January 2020. The first one in medium blue is a 2030 target date fund. Then in dark blue, we represented a US passive REIT. And then in green, we're showing core private real estate. And Trip mentioned this before, Michael mentioned this before, you can clearly see the benefits that private real estate offered a multi-asset portfolio when the market corrected in the first quarter of 2020. Here's where it gets interesting. Now we're inside the plan and the investor portfolio. Their broader portfolio declined. They have an overweight to private real estate, which really helped them, but now they're overweight in their real estate allocation. And suddenly you get to the middle of March and you recognize investors are now asking for liquidity to rebalance their real estate back to target. But almost half of their liquidity sleeve has already been wiped out because of the REIT market decline. And the question then at that moment is not just how much liquidity do they need to rebalance, it's how much liquidity do you want left to take advantage of the behavior of REITs, because REITs rebounded 13% during the second quarter. So it's that play between the benefits that private real estate offer and REITs, because REITs traditionally rebound between 1 and 3 months after a large dislocation. Food for thought. Why don't we move to the next slide and look at investor behavior? So, Greg, imagine you're an investor that's in a blended real estate fund, approximately 15 to 20% in REITs, and you made 3 rebalancing trades in the third quarter of this year, 4 rebalancing trades in the second quarter. And what we've done is we've taken all of your trades every quarter, we've aggregated them together, and we're showing them as a dot over your market value. So it's percentage of your market value is what the trade represents. Then we went back 5 years and we layered these 60 quarters on top of each other to see, okay, what was Greg's rebalancing behavior, and also include other investors to give you a range of investor behaviors. So if you then take a look on the left-hand side, which is essentially investors' quarterly redemption needs, it's interesting to note that investors used up to 15% of their investment in the DC real estate fund just for normal market rebalancing, which is the blue dots. And the red dots represent investor liquidity needs during the first 2 quarters of 2020, which we just talked about earlier. That's actually higher than most investors anticipated when you have this conversation. And if you then look over to the right-hand side, the contributions, the takeaway here is that Greg and other investors used up to 18% of their market value in the DC real estate fund just to manage real estate within their plan. And the takeaway here is that investors need to thoughtfully consider what are their needs and what type of fund do they want to invest in, because there's a range of options out there with a range of risk profiles and a range of liquidity profiles that can suit the investor's need that's looking.
Yeah, I just think there's so many good points here. I think Yanni brings up a great point that, when you think about liquidity in private real estate, the first thing that comes to mind is, being able to fund redemptions, but really putting money to work is just as big of an issue. And also, it's not necessarily about, what real estate does. It's about what these other asset classes do, because if there's a big run up in one or another, or a downturn, it can get your allocations out of whack, and that's got to be fixed, of course. So I think there's just a lot of really good points here for everyone to hear. Thanks, Yanni.
Yeah, the challenge of using REITs as a liquidity sleeve, and then to have their value drop precipitously as you're using them for your liquidity, and then to have it bounce back precipitously. It sounds like maybe you need a little bit more margin than some have thought. Am I understanding this presentation correctly, Yanni?
It depends on the investor, and it depends on how the investor wants to use their exposure to REIT. I would say if performance is important and they're being benchmarked against a blended benchmark, then that is a consideration that they should look at. And there's some investors that choose to invest separately, directly in private and directly in REITs, so that they have the flexibility to change that allocation depending on where they are in the glide path. So I don't think there's an answer that one fits all. It's just a consideration that's really specific to each investor.
Do we have any more? Do we want to talk any further on the slide, or shall we end the slide?
I think we're all wrapped up. And if there's any questions, that would be great.
I do actually have a question. Both Yanni and Greg mentioned corporate actions. How have plan sponsors managed around corporate actions / events? For example, if a company spins off a business unit, generally the corporation has to also spin off a part of its 401k that goes with the business unit. How do plan sponsors manage this event when using private real estate in the DC plan?
Communication, open communication and lead time, because it does happen where you could have a spinoff or a company breaking up their 401k plan. The more advance notice the DC or the real estate investor has, the more times it gives them to work with the plan sponsor on the date that that spinoff is going to happen, because that real estate allocation has to move with the rest of the plan. And it's been done many a times. It's just communication. On the other side as well, when there's mergers, when you're communicating to your participants that we're bringing in the merger, we want exposure to real estate on that date, here's the funding amount, here's the 100 million, when are we going to get it into our plan? At the end of the day, it is planning and communication again. Greg, on your side, any comments?
No, I would agree with that. I think this is getting better. I mean, we see this in stable value, and we've seen it for years and years. So a lot of experience with this. And what we've noticed is that people are getting better about communicating. You know, unfortunately, they can't always tell you when a merger is coming or a corporate action is coming because there's SEC issues, of course. But to the extent they can tell you the moment they are able to, so that, you know, the manager can prepare and everyone can work together to make sure that you know, participants are getting the best outcomes, because that's what's the most important.
I have another question from the audience, and again, I encourage everyone, hit the Q&A button. We're going to be posing these. Can you comment on the use of lines of credit as a liquidity safety net? Either of you want to jump?
I'm happy to comment on it. I think there are some options in the market that do have lines of credit that really sit behind the DC real estate vehicle. There's lines of credit that sit behind the private real estate, whether an investor invests in the private or in the DC. We've never actively had to use them on the DC level. And I'll put it at that point where it depends on how you structure and you manage liquidity. And that's one of the reasons why these vehicles are only available to professionally managed plans, because you're eliminating that participant volatility that comes from it being directly available.
Greg, do you have
I would agree. Sorry, I would agree with that. I think lines of credit is something you heard about earlier in the evolution of these products. And I think especially if they were directly exposed to participants, and that, you know, this was uncharted territory at one time. And I think some plan sponsors, you know, wanted to hear about a safety net of a line of credit. The trouble with a line of credit is that it costs money. It costs money to have a line of credit sitting on the sidelines. And when it's not being used, it's just friction on the portfolio.
And that gets to the all-in fee sensitivity, because there's the management fee and then there's expenses. The line of credit adds to the expense load. And I think the industry is more sensitive than it has ever been today.
We've touched on this, but I wonder if we could go, if you could talk just a little bit more about what are some of the key considerations around implementation? What sort of questions are you being asked as you're setting up your plans?
Sure, I can kick that off, and then Yanni can chime in. Just one issue I was thinking about is, you know, Michael mentioned the plumbing of DC, and it's a great word to use. And it's interesting when you look at target date funds. You know, a lot of them are built where every contribution, every dollar that comes in is allocated pro rata to every single underlying holding. Now, that's getting better. I think target date managers today are starting to think more in terms of tiers of liquidity available to them in their portfolios. That, of course, takes more management and more time and more involvement from you know, third parties and vendors. But that's really the way you have to look at it when you start introducing illiquid asset classes. you can't possibly hit every asset class with every allocation that comes into the portfolio.
I would agree with that. And I think that is also one of the things that have been supporting the growth of OCIO, just because of the amount of management and fiduciary responsibility that sits on the plan sponsor,
Exactly.
where that is it. I think there is a movement for them to move that out to OCIO platforms, and that's been supporting the growth.
I have another question come in. What impact will the blockchain have on making real estate more accessible to DC plans, do you think? Obviously, it's early, but do you think it could become a tool in the future?
I know enough to be dangerous, so I would say there is definitely potential for it to increase the use of real estate going forward. I think it is still a ways out, but there's definitely firms out there looking at it to see how they can more commoditize real estate and the ownership of real estate.
Greg, any thoughts?
Yeah, I'm certainly no expert on blockchain, but my understanding is similar to Yanni's that the idea is that you're trying to make a fungible trading platform for illiquid assets and sort of democratize illiquid assets. And there's quite a few firms working on this, and a lot of people with some really brave ideas. And so I think there could be some interesting things coming on the horizon there.
Now, Yanni, I want to talk a little bit about target allocations within the real estate. What are you seeing, and what do you think are some of the best practices around that?
What I'm seeing is very exciting because allocations are moving up. So I would say 5 years ago, a lot of plan sponsors were dipping their toe in the water. They were around 5% to private real estate or 7% to blended real estate. It was also partly due to real estate playing a very traditional role of, absolute return-wise, it was sitting between equities and fixed income. On the efficient frontier, it made sense, and the cycle just kept running with equities. So late in the cycle, it was more challenging to support higher allocations because equities was running so strong. But if you look at where we are today, post-correction, there is the view that traditional asset class returns have come down. If we look forward into the next cycle, where core private real estate is still sitting at a strong 6 to 7 over a full market cycle. So it's adding more value from an absolute return perspective, which is the point I made earlier. And we are seeing clients moving up their allocations 300 basis points and then 20% close to retirement. And they're making that change within 6 months after COVID happened, and the general view on the benefits of real estate increased. So I think we're definitely going to see existing allocations to real estate move up across the board, and also new investors looking at the value that real estate brings to the table today. We ran one scenario where we said, if someone was 25 years old today, and we add 15% real estate to their glide path, and we run them to retirement, and then we run it down into the spending phase, the allocation of real estate increased their balance at retirement with 14% and added 3.5 years to their retirement if we looked at the benefits that it offers today. So there's real benefits looking at real estate at the next cycle, and we haven't even touched on inflation.
Well, let us take a moment to touch on that in just a second. But one of the things that I noticed, and this is also true when Greg, you presented the target date glide path, a lot of what we're talking about is private core real estate. Do you see a space for value add or opportunistic real estate investing? And would that be something that happened earlier in the glide path with a shift toward a more income oriented core later, maybe in the decumulation phase? Yeah,
that's what I was alluding to earlier, Loretta. That's a good point. I think, and look, that may be a couple of stops down the line for the real estate train in DC, if you will. But I think we could see some evolution there. We could see the introduction of, maybe some higher risk real estate in those, earlier portfolios. But as Yanni said, I think you can certainly you can certainly justify the use of Odyssey funds earlier in the glide path as well. So it need not be higher risk real estate. But a lot of it's going to depend on investor experience. A lot of, our clients are looking back at, experiences they've had on the defined benefit side. And that's really what they're drawing from when they think about, how to apply real estate in a DC context. But then, and then as you get later in the glide path, higher income producing real estate, possibly private real estate debt, you can definitely see a place for that. And I think we will see that eventually. If you think, 5 or 10 years down the road, we're probably going to see quite a bit of evolution there.
And Yanni, you mentioned you just briefly mentioned inflation. What are we seeing as far as plan sponsors looking at real estate as an inflation hedge? Is that a conversation that's being had now?
Yes, that's absolutely a conversation that's being had, and they're asking detailed questions about the behavior of the asset class historically. How has it really helped mitigate the impact of inflation? And are we in an environment today where those similar dynamics will be coming through? And the answer is yes. I mean, real estate has demonstrated its ability to mitigate inflation in both periods of high inflation, such as we saw in the 70s, and more normalized inflation from the 80s to where we are today. And there's a lot of questions on what inflation is looking like today, how long will it last, and will it come down?
Greg, any thoughts on real estate and inflation?
No, just that we, no one talked about inflation at all for years, and it's definitely back in the forefront. And so I would expect more discussion about inflation and what to do about it in a DC context going forward.
I just want to mention we are getting close to the end of our panel. So if anyone has any additional questions, do get those in as soon as possible. Otherwise, we are not going to be able to address them. But with that, we've talked a bit about implementation, the process, the structure. Do you have any other thoughts, Greg or Yanni, about how this implementation should be done, and what should our audience be thinking about, today?
I would say implementation for every plan sponsor is slightly different coming from a manager's perspective. That is why you need to make sure that you have the people in place that can really bring the pieces together at that moment, because that's where the wheels can come off. But the market has evolved so much, and the record keepers are more experienced, the custodians are more experienced, the managers are more experienced, that I think we've overcome a lot of the hurdles that presented 10 years ago. So again, open communication, clearly talking about when, how, understanding your liquidity needs and the product that you're investing in is important.
Greg?
No, I think Yanni nailed it.
Well,
I've lived it.
Well, I haven't gotten any more questions in from the audience, so I think we want to take a moment to make sure we've addressed everything you want to touch on. Do either of you have some key takeaways or questions for each other?
Well, I have a question for Yanni and a topic I'd like to bring up, and that is, what about plans? So far, when you look at who's adopted private real estate in DC, it's really plans that have and also a defined benefit plan where the people you're talking to have a defined benefit background and they're very familiar with real estate. So how do we reach out to more DC only type structures where there isn't that history, there isn't that background of real estate, and how do we educate those plan sponsors on the benefits?
It is a challenge, but one thing that I will say is if you look at who in the DB and a DC part of the organization manages the retirement, it's very seldom that those teams actually overlap. So you're having two completely different conversations, even if the DB part of the company is already a client. What we have seen is thoughtful, innovative companies that only have DC plans that actually make the decision to move out of Vanguard and set up a custom target date solution to be able to access best in class solutions. And I think the more we have the conversation of outcome, what are we solving for here? It's not just about the solution and the point in time. The more the DC investors will recognize those benefits and start bringing them into their plan, because at the end of the day, it's going to be a blend of passive and active, because fees will always be a consideration. But I think it's focusing on the outcome conversation. What are they solving for, and how do they want to improve their participant outcomes?
That's great.
Yeah. And Yanni, do you have any questions for Greg?
Greg, you mentioned other types of real estate, higher risk real estate debt. In your view, where could those be more applicable in the future? Later in the cycle, in different areas in the glide path you mentioned, at the front end of the glide path. We looked at, we saw a number of real estate debt managers coming out late in the last cycle. So I think my question is, at what point do you think the market is evolved enough to be able to pick and choose and build the solutions that they want, whether it's real estate equity or real estate debt?
Well, I think we have a number of real estate equity managers, at least when it comes to, Odyssey geared funds that are daily valued. I think that there's definitely more room for innovation there. And as I said, I think the market needs to get comfortable with private real estate in general before they start, looking at different flavors. But you could definitely see higher risk real estate earlier in a glide path, no question. And I think that and in terms of debt, I think a lot of it in the current environment we're in that looks like it'll go on for quite some time is there's a search for yield going on. There is no yield to be had out there unless you start looking at things like commercial mortgage debt. So I think that that's going to be the appeal. You could definitely see in a retirement income context where not just core real estate, but also debt comes into the equation as a way to generate income, because it's going to be more and more difficult to do that. It looks like for the next 5 or 10 years in traditional asset classes.
Yeah, absolutely. Looking at the target date fund glide path that you presented, Greg, the retirement era with that huge chunk of fixed income, right now with the way fixed income is going, there's just a real opportunity for higher yield credit.
Yep. Agreed. Yeah. And there's not a huge appetite for volatility either. So yeah, I think it's an area where real estate can really fit the bill.
Okay. Thank you.
Well, now I would like to thank both of you and maybe go to each of you for sort of a key takeaway from this panel, what you're hoping the audience will walk away from this webinar, maybe the whole panel, the whole 3 panel, but especially yours. Greg, I'll start with you. What's your key takeaways from today?
Sure. Well, Loretta, I think it's been a great conversation. I'm looking back at my notes here. A couple of my takeaways. I think first of all, a lot has been mentioned about the size of the DC market, and it's going to continue to grow. I was just looking at some Investment Company Institute numbers during the panel today, and they're estimating $13 trillion in DC assets by 2025. So the growth will continue even in the face of some demographic headwinds. Excuse me. There's no question this pool is growing. I think Michael talked about the DCREC and establishing best practices. It's really important for our industry. I think that we want to all be playing towards the same goal here, and there should be plenty of assets to go around. Really sharing best practices, educating the marketplace. We talked about some of these DC plan sponsors who have no real estate background. We need to continue to educate the marketplace on the benefits of this asset class, because real estate is needed in DC for diversification benefits alone. and to limit the range of outcomes for participants, and also to help beat inflation and provide income as well, and other reasons. So there's it's funny, in my career, I've seen people try to force asset classes into our investments into DC plans. Over the years, I've seen many failed attempts there, but this is not a force. There's a definite need for real estate in the DC marketplace.
I would absolutely agree with that. And I think investors can also take away that this is not new. DB plans have been investing in real estate since the late 70s. And private real estate in DC really started growing in the mid 2000s. So there's a 15, 16-year track record here of private real estate being incorporated in DC plans. And it offered benefits during the last cycle, and those benefits are even enhanced going forward. And that in itself, just take a look at the asset class, see what it can contribute to your participant outcomes, and make a decision from there.
Well, I'd like to thank Greg and Yanni for joining us. Your thoughts have been really helpful, and seeing how this implements, what kind of implementation options, how this might look, I think really kind of grounded this conversation that we've been having all day. So I really want to thank you for providing that sort of grounding, nitty-gritty place. So before I bring Jeff on, I just want to thank Greg. I want to thank Yanni. I want to thank all of our panelists today. Thank you so much. And just for the audience, I will say we will be sharing a replay of this. Everyone will get a chance to review this this slide. Thank you, Yanni. Thank you, Greg. Go ahead and turn off.
Thank you.
Thank you.
And Jeff, if you could join us.
Well, here I am.
Here you are.
Wow, great discussion, guys. Thanks to all of our panelists. I think it's been true of all of our recent webinars. Each has been designed to open up our collective eyes to forces that are shaping the future landscape of the real estate investment management playing field for both investors and the people and companies who serve them. I think it's interesting to note that Chris Katarna, who keynoted our last public live event 19 months ago, our VIP conference in Barcelona, advised our audience that if you want to understand what the future is going to look like, pay attention to what's going on at the margins of your field of vision. And what's clearly been going on in the margins of our field of vision, at least for most of us involved in the institutional real estate investment business, has been nothing less than transformational when it comes to the change and shift from defined benefit to defined contribution. So for those of you who aren't thinking about how to jump on the bandwagon and get involved in serving the DC pension fund market and the private wealth advisory market for that matter, you may soon find yourself like I once did at one of my first PREA meetings, standing all alone in the cocktail party room as everyone else already had left for their offsite dinners and social events. Maybe you've had that experience at PREA when you first started going as well. Equally interesting, I think, is 14 years ago in 2007, Casey and Quirk, in joint venture with Merrill Lynch, published a landmark white paper titled Brave New World. One of the observations in that white paper was that the traditional 40-60 fixed income equities portfolio mix in a lower interest rate and lower return environment was going to be insufficient to meet institutional and individual investors' financial objectives. The report also pointed out that the individual investors were underexposed to alternative investments that they needed to achieve their objectives, but also incredibly ill-equipped to make informed investment decisions about adding these kinds of alternatives. Consequently, they predicted in the white paper that there would be an emergence of a new breed of professionally managed multi-asset investment products that are blended together with the asset allocation decision already baked in. And interesting enough, that's precisely what's been happening over the past 14 years. So again, if you're clinging to a business as usual approach to real estate investment management, you probably can continue to do so profitably for a few more years. But if you cling to those notions too long, you could have being among those like me who will be holding the bag at the end of the cocktail party. Finally, in closing, if you are interested in pursuing the defined contribution pension fund market, you should know that the people who run these programs are not the same as the people who run the DB side of the house. just identifying who to contact on the DC side of the house can be a real challenge. Recently, I asked a friend of mine at a large public pension fund recently if she could refer me to the person responsible for managing investments on the DC side of the house. And she responded, I don't even know who that is. So to help all of you, our data services staff have been reaching out to large DC plans to collect contact information for the people running the investments of these plans. And we now have several thousand records updated in our IREI database. So there are resources available to help accelerate your efforts in this area if you're willing to investigate them. In addition, we've been attempting to get these investors to become subscribers so we can help educate them on the real asset related alternatives available to them that are plan participants. So just as we helped educate the DB plan market in the early days of the business, we're doing the same or attempting to do the same for the DC market as well. I think also if you're focusing on the private wealth advisory market, you should check out our Real Asset Advisor publication, which now reaches more than 60,000 private wealth advisors throughout the United States. And again, what we're trying to do there is educate and provide information investment decision-making infrastructure for those advisors. And I would also add as a caution, if you're not making an effort to study blockchain and its potential for disrupting business as usual in the real estate business, you're exposing your business platform to a great deal of unnecessary risk. So in closing, I'd like to again thank the sponsors for today's program: Bentall Green Oak, Clarion Partners, Heitman, Invesco Real Estate, JP Morgan Investment Management, wouldn't you know, JP Morgan Investment Management and Nuveen Real Estate. And thank all of you for tuning in. We hope to see you soon at our annual meeting of our Institute for Real Estate Operating Companies, or at our annual Real Asset Advisor editorial board meeting, at our VIP conference in January, or at our next webinar or virtual roundtable events. Meanwhile, take care and be careful out there.